Welcome everyone to Joseph Carlson After Hours. In this video, I'm going to be talking about a company that I'm going to be buying this week quite a bit. In fact, I plan on making it one of my core holdings in the passive income account. The company is called Texas Roadhouse. It is a restaurant. And I'm going to go over why I'm picking this one over the other many options and why I'm buying restaurants at all, even though it's a highly competitive industry that offers very little moats. So I'll be going over all of that. We'll explain the investment thesis here. I've gone over some other, other companies in the past like CrowdStrike and why I'm buying that one and the Story Fund. But I want to go over this one and give an overview of why I'm adding it to my public passive income account. So if we go into the passive income account, currently it has a value of $180,000. So if I go down to this, I can go over a few of the bigger bets that I've been making, the bigger companies that I've been trying to buy into. One of them is Disney. I'm up $3,000 in Disney. Now the holding size is $20,000 because I've continued to buy this company. That's when I want to be a core holding. Another one is Costco. I have $16,000 invested in Costco right now. That one I'm going to continue buying as well. And then we have Home Depot and Nike. These four are ones that I want to make very big core holdings of my portfolio. If I move on to tech and cloud computing, I renamed this from just tech because I wanted it to be a little bit more specific. I have Apple and Microsoft. Those are the two big tech cloud computing companies that I think are making up core positions in my portfolio. And then in fintech and banking, we have JP Morgan. This is a dividend paying company that does share buybacks. That's a fintech company that's also a big bank. I think it has it all. It's competing fiercely with other fintech companies like Square and PayPal. But this is one that's one of the bigger holdings in my portfolio and has performed really well over the past couple months. So these core holdings like JP Morgan Chase and Apple and Disney and Nike and Costco, these are ones that I think are great companies with very good futures, very good long-term outlooks. You don't really have to worry about the day-to-day price of the stock because they have really good long growth paths ahead of them. And what I plan on doing is adding to that collection of companies. And I've been looking for ones that are in the restaurant and delivery area. So either restaurants that can take advantage of DoorDash and Uber Eats, or restaurants that are really good at takeout or just dine in. And I think that identifying good restaurants right now is really important because I see a ton of demand for restaurants while many of the smaller ones go out of business, which I think will even create future demand. So in the passive income portfolio, I actually created a new category. This is brand new. I have $5,800 in it. So I'm investing heavily into this and I'll be putting more money into it this week when the market opens. But in this category of restaurant/delivery, we have two right now, Texas Roadhouse and Cheesecake Factory. I've looked at so many restaurants over the past few days. I've looked at Chipotle and Wendy's and Burger King and Darden and all the different ones, Chili's, all these different mini restaurants that you can look at. And I did overviews of the balance sheets and the things that I liked about them and the amount of debt and all the different things that you can look at. And I'm going to go over why I chose Texas Roadhouse as my favorite investment right now. So first of all, before we go into the numbers and the bull case for Texas Roadhouse, let's find out what this company actually is. Doesn't that already look delicious? Some fried chicken there. If I back up on this video, this is a video from the YouTube channel called Delish. And I think this was like a year ago. They did a video on Texas Roadhouse where they just went over and they have one of the girls from the channel do like a review of the food there. But this gives you a little look of just the front of the restaurant. They actually have very unique styles for Texas Roadhouse. Most of them are standalone locations. So they aren't just part of a big mall outlet. I think this might be a rare one, but most of them are standalone locations. They have a very unique look to them and they spend a lot of money making them themed really well. So they invest about $5 to $6 million per restaurant. And that's what they use to build it. So every new additional restaurant is about $5 to $6 million. Now, she goes into there and then she starts trying out all the different foods. Rattlesnake bites, right? They have all these fun names for the different foods. It's just a fun place. And even if I go and I look at the background, if we look at the background of this, do you see how it's themed? They have signs and writing all over the place and they have nice booths. It's pretty comfortable to sit down. It's just a really well-themed place. It's busy. They have music. There's a lot of chatter. And they always keep the restaurants pretty busy. She must be filming this at a time when they're not open because otherwise there would be people everywhere. It is a busy restaurant most of the time. And part of the reason why is their business model. We'll go into that later, but they do things like they only open at like 3 or 4 p.m. So they're only open in the evenings for dinner. But you can tell the type of food they have here as well. Look at that burger, the fries, the steak. I think in this video, she tries like everything on the menu. And steaks is their most profitable item that they sell. So they sell a lot of steaks and they make a lot of money doing it. So that's a look at the menu. It's a fun place to eat. In my opinion, I think it's good food. But of course, food is subjective. Some people might think this is bad food and they can get good food elsewhere. But as far as this type of cuisine goes, I think they do a good job. But food doesn't create a competitive advantage. You can go to a lot of places and get fried foods and fries and potatoes and ribs and all this different stuff. There's lots of good restaurants that make good food. So what is it unique about Texas Roadhouse? Why am I picking this investment, that really has no competitive moat with its food? Any type of food really doesn't have a competitive moat. If you look at Chipotle, it's been very successful. What does it create? It creates a tortilla wrapped with beans and rice and a few other things added to it. That's basically what Chipotle is, but it's proven to be a very good investment over the past couple years. And I think that's because of other things that surround the whole package of the investment. Not just the food, but the way that they run the restaurant, the leadership, the way that they theme it, the way that they expand. And all of that together, I think, creates more of a moat than people give restaurants credit for. Some restaurants that have fantastic food fail. Some that have fantastic food succeed because of the way that they operate and run the restaurant. So let's first go over the guy that runs Texas Roadhouse. His name is Wayne Taylor. And he has a cowboy hat on, right? He looks like a cowboy, and he's the one that founded the restaurant. So it's founder-led currently, and that's typically a big thing you want to look for. He's the guy that really owns this restaurant, that created it from the start. He's ran it the entire time, and he's run it very successfully, and he's still running it today. So this is in August 11th, but he's still running the restaurant today. So here's an actual look at him. Again, he has a cowboy hat on. This guy is running the restaurant, Texas Roadhouse, probably doing something he loves. And he's been very successful. In fact, in these type of interviews, you can look him up, the CNBC interviews with him, they're basically asking him, how are you being so successful? You're making so much money during a pandemic while other restaurants are struggling. But Texas Roadhouse is succeeding, and they're doing it very fast. They're growing rapidly right now during a pandemic, and they were growing rapidly before it. So this is a company that seems totally recession resistant. It's almost immune to the pandemic. It's immune to the recession. They really haven't had any major issues despite the tremendous circumstances we face. And so they're asking him how he does this. And he tells about how the restaurant, even though it might seem like a very rigid business, is highly adaptable. They can do dine in, and they can do dine outside, they can do takeout. They have a good technology team developing the apps for them. They have a Texas Roadhouse app that you can do on wait lists and all this different stuff. They've pretty much adapted easily to this new environment. They've really been a success during it. But even during this time of uncertainty with the coronavirus, he's been very conservative. So even though things are going well, they really have played things safe and positioned their company to withstand any type of reversal, any type of bad event. For instance, he said in 2020, he's not going to take a salary. So the CEO of the company said he's foregoing his salary in 2020 just to make sure, because the situation's unknown, as well as they temporarily froze the dividend. They said they're going to hold off on that until the coast becomes clear. Right now, they could pay the dividend, but they're still holding off because it's still an unknown environment. But my suspicion is that they'll reinstate their dividend as soon as the coast is clear. But until then, they really want to hold on to as much cash as possible just to make sure. So we know the CEO of the company. He's founder-led. He's run it the entire time. He's been very successful running it. We know about the company itself, what it looks like, the type of food that they have. I think it's a pretty high-quality product that they sell. We can go over now and look at the financial strength of this company. And this is where Texas Roadhouse really shines above its competition. I looked at a lot of companies and try to find one that has as good of a financial situation as Texas Roadhouse. In total revenues, the top line growth, this is the first thing you look for if you're wanting to invest in a growth company, or you're wanting to see a company that's growing rapidly, is how much revenue are they growing year over year? And look at this graph. They're growing their revenue steadily every single year. It's just like a schedule. And they did that in 2020. as well as they're doing that going into 2021. In fact, if we look at the percentages, they grow somewhere between 10 to maybe 12, 13% consistently year over year. That is great growth for a restaurant. Not a lot of restaurants are growing that fast. One of the only ones is like Chipotle. That one's growing between 15 and 20%. So it's growing slightly faster, but Texas Roadhouse is really growing. The top line growth is very impressive, and they should be able to maintain this for a long time going forward. If we look at the number of establishments of Texas Roadhouses, right now they only have about 580. So they don't have a lot of them, but they're growing this number about 30 every single year. So they're going to be adding on hundreds of new locations over just like the next 2 years. And that increases part of the growth because new locations obviously increases their revenue. But not only that, they're able to grow the same location sales every single year consistently. So the company's same locations are growing, and they're growing the number of restaurants, and I don't think they've even come close to saturating the US. But they've also seen good demand even internationally. Whenever they open up a restaurant in Europe, they've seen good demand there as well. So the top line growth I think is very impressive. Then we can go down and we can look at the net income. A lot of the growth companies you see today with tech companies are not profitable. They dump all their cash flow back into operations, and they never run a profit. And the way that they grow is by marketing. They have huge marketing budgets. With Texas Roadhouse, it's different. Not only is this a profitable establishment, but look at their net income growth over time. They make more in profits every single year, and they've continued to do that even in 2020. They've gone and they've made, in 2018, $158 million, in 2019, $174 million of net income. So this company is growing like crazy. The revenue growth is like crazy. And not only that, they're profitable because unlike many of the tech companies that rely on expensive sales teams and sales funnels, Texas Roadhouse just opens a location and they grow organically. The organic growth is very important. You look at companies that grow organically, and that's kind of what you want. You want companies like Costco. They just open up a location. People say, hey, there's a Costco. It's the cheapest. It's the best place to shop, so I'm going to go there. Different services like Spotify. It kind of grows organically. People share it with each other. They tell each other about it. They might do some marketing or promotions, but they don't have to work super hard for every individual sale. Texas Roadhouse is growing organically. It has top line growth and bottom line growth. It's growing its revenue and it's growing its net income. And the net income growth is actually accelerating in some aspects. They've gone some years with 8%, 11%, 19%. 19% net income growth, 13%, and then 20%. So their net income is growing. Now that net income growth and that revenue growth has allowed their payout ratio to remain consistent for about a decade while increasing the amount that they're paying out to shareholders substantially over that amount of time. We can look at the payout ratio history. It's somewhere between 40 and 50% typically. So they've kept their payout ratio very consistent, which you don't want to see companies that the payout ratio keeps creeping higher and higher. That's a red flag. That means that their payout is going to be unsustainable. They won't be able to afford to pay shareholders. Not the situation that Texas Roadhouse is in. I can look at their dividend history, and just at a glance, you can see the growth of it over time. It started out in 2011. Every quarter they were paying 0.0795, so not a whole lot. And then it's gone up to the point where now every quarter they're paying you 36 cents a share. So it's not a big dividend. The price of the company has also increased. But you can see their commitment to steadily increasing the amount of money they're paying shareholders while not paying them and putting their company in a bad situation. So this is a great dividend growth company as well as just a growth company. Now, if we go back to the financials, we can take a look at the balance sheet. Let's load this up. This is where we get into their cash position, their debt, what financial standing is this company in. So if we look at the amount of cash that they have right now, they have $100 million in cash, just sitting there in the bank, earning them interest. If you look at their actual net interest expense or income, they're earning interest on this cash. So the $100 million is sitting there earning interest, and it puts them in a good situation. Now, if we look at the long-term debt, which is how much debt the company has, they have exactly zero debt as of 2017. So they paid off all their debts. They had $100 million in cash. Now, just recently, because the interest rates dropped to such extreme low amounts, they took out some debt. They took out about $200 million of debt, and that raised their cash position to $300 million. So they have $300 million in cash, they have $200 million in debt. And the reason they did that was just in case they needed it, They wanted to take advantage of the low interest rates. So it's a total financial move just to secure a very low expense line of credit there. But the same situation applies. They have more cash than they have debt currently, and the debt that they do have is very inexpensive. It's at a very low interest rate. So this company, again, just reviewing the financials of it, they have top line growth. They have bottom line growth. They're growing the amount of restaurants and locations every single year, like 20 or 30 at least. It wasn't interrupted in 2020 during a pandemic. They're profitable even during a pandemic, and they have a net balance sheet of $100 million. So they have about $300 million in cash, and they owe about $200 million in debt. And they did that specifically to take advantage of very cheap financing right now. So this is a company that has a wonderful financial situation in terms of the balance sheet and the income statement. So far, I like the investment. I like everything I see about it. I like Texas Roadhouse eating there. I think it's a good place to eat. It's decent food. It's family friendly. It's a fun environment. It's very upbeat. And it always has kind of a busy feel to it. So I think it's a pretty fun place to eat. I think that people will pick it over other restaurants that are a little bit, not as fun and lively of an environment. So that's the first thing. I like it as a product. The second thing is I like that it's a CEO founder-led company. The same guy that's made it a success so far is still over this company. He's still running it, and he's still fully committed, doing interviews and talking about it. This is his creation, and I'm sure he takes that very seriously. So it's founder-led. That's what you look for. It's a good product, high quality. The other thing that we can look for is a moat. Unfortunately, any restaurant really doesn't have a moat. So that's a downside of the business as a whole. If you're looking to invest in restaurants, I don't think you're going to find one that has a significant moat. There's always competitors in the restaurant space. So that's not something that Texas Roadhouse does have, but I think it does have a little bit of a moat with the type of overall package, the branding, and the environment. I think it does have some customer loyalty. And then I like the balance sheet. I like the income statement. I like that a lot. This place is growing their income like crazy, both top line growth and bottom line growth, a bit slower than companies like Chipotle, but not that much slower. It's growing maybe, about 2/3 the speed, 3/4 the speed of Chipotle, but it is growing pretty fast nonetheless. So it's a growing company. They're not only growing in the number of locations, they're growing in same-store sales, they're growing their net income, they're growing their revenue, and they've launched 2 different brands, Jaggers and Bubba 33, that are going to test out, and they might be a different business model. They might be more fast food. So they're experimenting with different brands, and I think that there's a lot of potential with that as well. So Texas Roadhouse is a growing brand, and in terms of runway, I think they have right now an unlimited amount of runway. They have 500, 600 locations. They could grow that to thousands. Companies like McDonald's, there's 38,000. So having not even 1,000 locations, they have a huge amount of runway. They could grow both internationally. They could grow way more in the US. This is a company that has not even come close to saturating any type of total addressable market. So I like the leadership. I like the balance sheet. I like the long-term growth. I like the product itself. So with all that being said, the part that's really tough to actually get into now is the valuation. Texas Roadhouse dropped a lot like any company in March. It dropped to $35 a share. And that was just broad investors selling out thinking this company's going to go bankrupt. Little did investors know that it was going to do fantastic. So if you had some on-the-ground research and you were going there during March, you probably could have seen that. But to be honest, you could have bought a lot of things during March and done well. You could have bought solar companies and restaurants and tech companies and a handful of things. And if you bought right there in March and April, you would have made a lot of money. So the buys that I did during that time made a lot of money. Regardless, it's had a tremendous run. It's up 128% from its lows. From a couple of years ago, it hit a peak at 75, and it's marginally above that. It's 7% above where it was in 2018. So the company's, it's grown, but the number of locations have grown over 60 since then. They've grown their business a lot. They've grown a lot of revenue and net income since this point in time, and it's only valued 7% more. So looking at the historical graph, I think this will keep trending upwards. I think it's a stock that does have some momentum behind it. People are looking to own good companies, good brands. There's very few supply of it. People have piled into Chipotle. That's been the winning stock. In fact, if we look at a couple other ones here, we can take a peek at Chipotle. This one didn't dip down quite as much, but it's gone up tremendously. If we look in just 2019, it was $400 a share. And right now, Chipotle is $1,400 a share. So it's a full $1,000 more per share than you could have bought it in 2019. That is a really good return. You would have earned over 230%. So Chipotle has been the big winner. That one obviously is a great company. It's done fantastic. They have a really good business model. It's a very simple product, and they've expanded locations by the hundreds every single year. We can look at Cake, the Cheesecake Factory. This one is actually in the red for its 5-year timeline. And it dropped down quite a bit, and then it recovered again, like every other company. It recovered quite a bit. So Cheesecake Factory is actually trending back upwards as people look for good companies. And this one is one that I'm holding, but I'm not as bullish on Cheesecake Factory as I am on Texas Roadhouse. I'll probably go over that one another time, but it's a good investment. I think it has more limitations to its expansion. But Cheesecake Factory, nonetheless, I think is a decent investment, and it's likely going to trend upwards as well. We can look at Darden Restaurants. This is the one that owns Olive Garden, its most popular brand. This one has done really well as the others. It's trended upwards. This one does not have as good of a balance sheet or financial situation as either Texas Roadhouse or Cheesecake Factory. So people are paying more for the brand, but Darden is not in as quite of good of a situation as either of those companies. And then we can even look at Eat. This is another one. This is the one that owns Chili's. That's their biggest brand. This one has gone up like crazy as people race to it. But when I looked at Chili's, again, their growth just isn't there. They have some compelling aspects of the company, but the revenue is completely flat. So Texas Roadhouse has that nice growing revenue year over year, growing net income, and Brinker International, which owns Chili's, has pretty flat revenue. They're trying to grow it. They're doing some interesting things with cloud kitchens and stuff like that. So maybe they'll start growing their revenue over time. But right now, as you can see in the past, this company has been pretty flat. And I want my investments to grow and to pay me more dividends in the future than they do right now. So let's go ahead and do some valuation. This is relative valuation, meaning we're not trying to find the intrinsic value of the company, but rather we're just looking at what this company is valued at compared to other similar companies, other similar type of business models. So let's do some relative valuation and compare these different restaurants to each other in terms of a few valuation methods. One of them that I look at that I think is a very good way to value restaurants, if you're valuing the same type of business, is the price to sales. It's the price/sales, the price of the company over the sales, which is basically a way of saying the total market cap over last year's revenue. What is that multiple? You take the total market cap, you divide that by last year's revenue, and that gives you the price to sales. And if we look at that, we see that Texas Roadhouse is not really an extremely high-priced company when comparing it to other similar types of businesses that have similar margins. Chipotle is a notable outlier. CMG is Chipotle, and look at the price to sales of this company. It's a 6.8, meaning that you can take their last year's revenue, and it's 6.8 times that is their market cap. That is an extremely high price to sales comparing to other companies. We have DRI, we have Darden there, which is at a 2.4. That's, decently expensive, but not extremely high expectations priced into that. And then below that, we have Texas Roadhouse at a 2.2. It's higher than a lot of other restaurants, so there is some expectations being priced in the Texas Roadhouse. It's not even close to Chipotle. It's a third of the price to sales of Chipotle. So it's not in the extreme, but it's also not super cheap. Down there, we have Cake, which is a Cheesecake Factory at a 0.9, meaning the amount that they revenued last year is more than the current market cap of the company. So Cheesecake Factory is trading at a 0.9 price to sales. Now, moving on, we can look at one other way of evaluating companies. It cuts through some of the different stuff like interest and expenses. This is the EV to Ebitda. So the enterprise value to Ebitda. This is another popular metric that people look at, specifically in the restaurant business. And again, this shows that CMG, which is Chipotle, is priced very highly. And that's not necessarily a bad thing. All that means is that investors are expecting more out of Chipotle than they expect out of other restaurants. They think the growth is going to be maybe twice as much. So if Chipotle is growing twice as much as these other companies, the multiple might be twice as high, and that might be deserved. But if we look at this shows something. Way down at the very bottom, again, we have Texas Roadhouse. Investors are not pricing in that high of expectations to Texas Roadhouse in comparison to other restaurants. And at the same time, Texas Roadhouse is growing pretty rapidly. It's growing over 10% year over year. Chipotle is obviously growing pretty rapidly as well. It's growing at like 15, 16% a year. But Texas Roadhouse is growing, and it's not priced anywhere as high. So I like the fact that even comparing them side by side, Texas Roadhouse does not have as high of expectations priced in as companies like Chipotle. With Chipotle, you're buying this company thinking it's going to continue to dominate. It'll have huge sales, and it will grow its earnings, and it will grow thousands of locations every single year, and it will continue to grow. That's what you're buying when you buy Chipotle. With Texas Roadhouse, you're buying it assuming it's going to continue to grow at about 10% a year. So looking at a relative valuation, I think that Texas Roadhouse, it's not some type of steal. It's not some type of deep discount. The company's priced with moderate expectations, but it's not anywhere close to Chipotle. That one, the expectations are at least double what Texas Roadhouse is. So this company, I think, has a decent valuation, and I plan on buying a lot of it. I'm excited about this investment. I'm going to be putting a lot of money in it. And to me, a lot of money is like $20,000. So I'm going to be putting about $20,000 in this company over the upcoming months because I think it will be one that I'll enjoy having in my portfolio for the next 5 to 10 years. Now, having said that, overall, I like the company. I like the product itself and the service. I like the leadership of it, that it's founder-led. I like the balance sheet, the income statement, the long-term growth trends. But there's one other thing that I like about the restaurant business right now. And that is that a lot of small restaurant businesses are going out of business, which leads more demand to the bigger ones. And I know that this is sad to say. I wish these companies weren't going out of business. So I'm not saying that I take joy in the fact that people are losing their livelihood because of the pandemic. But as an investor, you have to look at the situation right now. 100,000 restaurants have closed 6 months into the pandemic. That was just 6 months in, and 100,000 are closed. And of those, they don't believe that they're temporary closures. According to a new survey released by the National Restaurant Association, a staggering 100,000 restaurants have closed on a permanent or long-term basis in the U.S. Permanent or long-term closures, 100,000. That's nearly 1 in 6 restaurants shuttered. 1 in 6. That is wiping out competition for these bigger restaurants. So the ones like Chipotle, like Cheesecake Factory, like Chili's, or whatever restaurant that's surviving right now, when people are going back to these restaurants and they're spending money on food again, that demand has to go somewhere, and it's going to be funneled into the survivors. We saw the same thing with companies like Costco and Walmart. Lots of small companies had to close, and then Costco and Walmart took advantage of all their business. They had excess demand. And I think that we're going to see the same thing over a long-term basis with restaurants. So even if you're not investing in Texas Roadhouse, my advice is to look at the industry and try to see what companies in the restaurant area, what type of companies in this category are going to take advantage of all this demand, because it's a completely unfortunate situation we face. I wish things played out differently, but I'm an investor. I want to make money, and I think that these restaurants are going to have a lot of demand, seeing how many smaller ones are shutting down right now. So Texas Roadhouse is an investment that overall I think makes a pretty compelling long-term story. And so I'm going to invest in this, hope for the best with it. I'll be building my position. And since it's in the passive income account, I'll be doing more videos on it. It'll be public, and I'll keep you guys updated with it. But I hope you enjoyed this quick look at Texas Roadhouse and the reasons that I'm buying it. I'll talk to you guys next time.